Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at _finance. And if you want to join our community, finding-value.com, I dive deeper into all these topics, looking for investment opportunities and sharing them with everyone in the community. And you can see how to sign up there in the corner. Scrolling down, we've got unusual whales here. Prices are unlikely to drop dramatically as there are still too few homes for sale per CNBC, talking about the real estate market. And it's driven off supply and demand, guys, and also it's very local and depending on inventory. If your inventories are low, then prices are not going to drop dramatically. They're going to stay elevated. So again, I'm just going to stick with the theme here of that inventory and supply and demand drive real estate prices, and affordability is a function of your supply and demand. If you have too little supply and a lot of demand, you are going to see affordability go down. It will stay down until we see a better balance between supply and demand. It's that simple in real estate, in my opinion. Here's not Jerome Powell. He says, "Who is your favorite trading hero?" Jeff Bezos' ex-wife. Married here, divorced here. Well, I mean, that's kind of like buying a home and being able to refinance. Like, I guess females see it differently. That's their like ability to refinance. They just leave or get a divorce. But again, the person who gets divorced who's incredibly rich, they're all going to have a chart that looks like this, and then people are going to cherry pick that data. So yeah, obviously, but I thought it was kind of funny seeing this. Copper and yields have danced together for 2 decades, and they're moving in sync again. If this continues, the surprise trade of the year might not be this or that stock. It might be higher bond yields. Stay tuned. The 10-year US Treasury yields moving on up. We're seeing copper move on up. And when they get in sync, what that means is that the economy and yields are moving together. That's generally what occurs. You get strong yields with strong economies. Historically, that's been the case. But there are times where countries get into debt problems. They're printing a whole bunch of money, and then you get yields going up and copper not going up. Um, that also can occur. And then if it gets too strong, where inflation comes raging, you can see copper go up with yields because there's so much inflation in the system. The difficult part is, which one is it? Is it the economy getting stronger, or is it that we are printing so much money and the inflation's coming into the system? Or is it the economy strengthening over in China? Uh, China, they went through a slowdown recently in their real estate market. They've done a lot of stimulus to basically recover to some degree, and now they're going through a recovery phase. Is it strength? Is copper moving up because of strength over in China? But another factor, when we look at copper, it's priced in dollars. So there's currency exchange rates. There's multiple economies around the world where I would say India and China have a big impact on copper demand. And then there's the United States demand, supply demand and inflation and the value of the USD currency. This isn't a straightforward um, problem here. Now, when people say, let's just say someone's bullish on copper or someone's bullish on silver, and then they take a bet on the equities. That's a very complex bet. It's not so straightforward. It's not silver price goes up, the equity goes up. You're betting on currency exchange rates to some degree for the commodity itself. And then you're betting on margins with an equity. So you're betting on the input costs and the inflation impacting those input costs versus the commodity price, which is also subjected to currency exchange rates, and the companies are also subjected to currency exchange rates. A lot of stuff going on there. It's not so simple or straightforward bet. If I go buy physical silver, well, I don't really care about inflation necessarily. If the cost curves go up, that actually helps my physical metal pricing go up. The cost curve continues to increase. So yeah, that's those are all things that you have to consider when taking bets. And what I do is I like to get a little bit of the physical and then also get the equities. So you can get the leverage if that does pay out the way that people kind of hope it pays out, with the equities being highly leveraged. And then you have your physical metal kind of locking in those gains as the price of the physical metal goes up. Dear son, being financially stable eliminates 95% of your stress. Do I agree or disagree with the statement? I don't know if it's 95%. Um, I think it's probably lower than that. When I was when I was young, I think I mean I was young and I didn't have money. I wasn't really financially stressed out that much. So is that considered financially stable? Not me as a person, I wasn't, but I was around other people who were, like my parents. So maybe them being financially stable allowed me to not have that stress. So maybe that's the case. I think there's a lot of things that can happen in a person's life that can impact their stress levels quite immensely, like health. And you can be financially stable and be unhealthy and have health stress. Without health, you don't have anything else. So I don't think financially stable eliminates 95% of your stress. I would say that the majority is health related. So that would be if you're incredibly healthy, I would say that eliminates a lot of stress, I think, for people. And then financially is probably after that. Without health, you're kind of screwed. And then your finances come after that. If you're not healthy yourself, you can't help anyone else. And then I wouldn't say that all financially stable people are healthy. So I would say that health is number one, and then financially stable. So I would say it's a much less percentage than 95%. Most of my stress, at least the stress that I've had throughout the years, has not been from finances, but I've purposefully made sure that that was the case. So I think your stress just shifts to other things if you are financially stable. So it's difficult to say that financially stable eliminates 95% of the stress. I think things just move and morph into different things. Whether it's financial stress moves and morphs into health, or health moves into financial. I mean, if you have poor health and you're in the hospitals all the time, you could create financial stress because your healthcare costs are so expensive, at least here in the United States. So I would say health of your entire family, if you have a family, is incredibly important. And then I would say that all stems from what you eat. So your stress, if I were to say what should you stress the most over, I would say your diet and health, and then finances come after. Because if people in your family are not healthy, it can financially destroy you over time. It can be very expensive. Rick Rule says, or Rick Rule rhetoric says, we need to be finding and permitting a lot more copper mines. To change production tomorrow, we needed to start 25 years ago, and we didn't. And that's what scares me with copper. How do we solve this? I think there's going to be a huge gap between what's fulfilled on the supply side and the demand. And that huge gap is going to allow some of these copper producers to make obscene amounts of money. That's going to be true in a lot of different commodities sectors, uranium, energy, copper, nat gas, coal. I think they're all going to be subjected to uh, very large supply demand deficits that can't be fixed immediately. When I think of copper, I think that the shortages will be so great that we are going to have to build and buy a lot of equipment, mining equipment, build mines all across the world, and that's also more energy demand. As these ore grades decline, your energy input goes up. So I think it's also going to stress the energy component, whether that be electricity or fossil fuel demand for natural gas and coal or oil, diesel, whatever it is. Um, and I think it's not just going to be copper either. I think it's going to be everything. So everything's going to have lower ore grades, which is going to put more and more stress onto the energy side. I think energy is going to be the best investment over the next few years. I think precious metals could too, because if energy has problems and energy prices go way up, it's going to be seen in higher interest rates, and people are going to worry about the debt more. So I think precious metals and energy and a lot of these base metals too, they're all going to do very well. Very similar to 19, 70s, 40s, 50s, 60s, 70s. Howard Marks says the ability to persevere requires consistent adherence to a well thought out approach, control over emotion, and a portfolio built to withstand declines. You have to have a combination of those three. I agree. Yes. I think I think having a good strategy can help with your emotions and then being well versed in that strategy. I wouldn't build a portfolio completely based off of withstanding declines necessarily. Um, you want to be able to withstand declines. And I think when people think of declines, it's like they want to avoid it in its entirety. I don't think that's possible. I think people have to be resilient enough to withstand declines in the underlying equities. But that doesn't mean that you get to avoid them. You have to be able to bear them. A 50% decline in a bull market occurs, and it occurs frequently in a lot of these companies. So you have to endure that decline as you go through the bull market. I don't think you can time it. I don't think you can jump in, jump out. Um, I don't think you can time it well enough where if you're in a taxable account that you make it worthwhile trying to time a 50% decline because you're not going to time it perfectly. And then if you pay taxes and then you have to buy it back, you're going to have a 30, 40% decline if it's a short term gain to make it worthwhile. So you're going to have to time a 50% pullback pretty damn close to the exit and entry being very good. And I don't think most people can do that. So it's better because you can keep more shares invested if you don't pay taxes and just hold on. I think that's a better approach than trying to time everything. Also, the more decisions that someone has to make, I think it's harder to do and get it more to get it accurately done. So if you have to make 100 different decisions where you buy and sell different stocks at different times, I think you're subjected to a lot more error. So it's better to hold on through the bull market, accumulate the dips, than it is to try to buy and sell and time the market. A lot of the times, People make errors. And if the market goes up substantially on you, it's very difficult to get back in. So, in one of the books, Reminiscences of a Stock Operator, one of the biggest mistakes people do is they lose their position in a bull market. And that's what I'm the most afraid of, is to lose a position in a bull market, not be able to get back in from a psychological perspective at the beginning of the commodity bull market, which I still think we're in the early innings. So that's my fear. And Howard Marks, it's a well thought out approach, control over emotion, and a portfolio built to withstand the declines. Um, I think I think it's being able to get to the other side of the decline, not necessarily to be prosperous during the declines. Yes, you'll still feel declines, you'll still go down, but just to be able to make through it. That's the way that I kind of view it. 1999, the Fed is concerned about rampant equity speculation and its impact on wealth. The S&P 500 had a PE of 24x. Today it's 23x. Too tight labor market. Back then 4.3%. Today 4.1%. Too high of wage growth. The ECI 3.5. Today 3.6. Inflation core CPI 2.3. Today 2.8. They hiked from 4.75% to 5%. And again, household net worth close to 8 times disposable income due to strong financial and real estate asset gains is a tailwind for confidence and consumption. And again, that was from 1982, 85 as the bottom, and then the big move higher. This was the big bull market for equities. Equities had bottomed in the early 80s. You can see that bottom there, 76, 85. So this was like the big first hump. And if you look, this fractal, guys, from 79 to 85, that's a wave one fractal, it looks like almost, in this big hump right here. This is another wave one fractal in the beginning of wave three. So this is wave three here, this whole chunk. Wave one in wave three. And then this is wave five that we are in. And could we still get another blow off? It's possible. But that's the big move. And the big driver was a decline in interest rates. Now that interest rates are going up, I'm more than likely looking for a top here and a bottom in commodities and precious metals. And I think this is going to be a big bottom. And we're going to go into a very big bull market for precious metals and for commodities and the equities that are associated with commodities and precious metals. This is going to be a paradigm shift in the market that people are not ready for. They are not looking for this. So only about 2.5% of all Americans actually have 1 million or more saved in their retirement accounts per Investopedia. Only about 2.5% of all Americans have a 1 million or more. That's pretty crazy. John Templeton says the only way to avoid mistakes is not to invest, which is the biggest mistake of all. You're going to make mistakes. Everyone's going to make mistakes. You're not going to be perfect. Your strategy isn't going to be perfect. But it's a bigger mistake to not do it at all. Making money is about, the way that I view it, is about statistics and probabilities. It's not about being perfect. You're not going to be perfect on everything. You're not going to go up in all positions. There's going to be mistakes that are made. There's going to be things that don't work out the way that management planned. There could be unforeseen things that come from jurisdictional risk. There's a whole bunch of things. Taxes. Grady says, been saying lately, and the secular bull for junior commodity companies is about to resume, and now it is. Posted this one and other TSX Venture charts a couple of times during the last few months, and the fact that these charts got few likes shows people could not believe it. And that most have missed the move. At the same time, though, the 100 post on different sideshow narratives gets people excited and active. It is like most have forgotten that it is real value one should be looking for, and not waste time on attention-seeking posts, especially for things that are given to happen but years from it. This is probably, though, because most people look for instant gratification and are drawn to posts that offer the promise of things going to the moon as of yesterday. Most have no patience and not enough knowledge to sort out what is true value and what is not. Plus, most are not wise enough to seek world-class guidance. Again, this is the TSX Venture weekly log scale. It's broken out and it is cruising. This will impact some of the investments that we're in on the website too. The investments that we have are there's Canadian investments, there's precious metals, and there's probably 6 or 7 different sectors that we follow that go over shipping, dry bulk, tankers, um, oil and gas, energy service, coal, uranium, precious metals. There's a whole bunch of stuff. And we've had really good entry points over the past few years. And I do think that we are getting better and better with time. Are we witnessing the start of a much awaited commodity super cycle? Surely the silent depression can't last forever. And commodities are going up. We bottomed here 2015, 16, 17, all through there, and starting to head higher for the US Commodity Price Index, 10-year rolling compounded annual growth rate from 1815 to 2025. And they've got a peak at 2045 for the cycle, 2045 for their opinion there. Rhodium, any day, in my humble opinion, a ton of energy when we pop 600, which equals $6,000 rhodium. Big breakout potentially for rhodium. Looks like a big double bottom to me. And we are heading higher with big kind of flag pennant formation. Freight futures AM update. Dry bulk, Capesize is flat, Panamax up 3%, and tankers VLCC is flat, and Suezmax is flat as well. Brady, been saying that the inflationary 70s will repeat and most probably be dwarfed hugely. Dwarfed. Posted this chart 3 years ago and linked. Post below when price was at bottom of the right shoulder, then posted the chart at pink breakout and backtest. It is now up right against the 45-year blue inverse head and shoulder neckline. This is gold versus copper, and gold could break out against copper and have a big outperformance where gold outperforms copper. I do think that copper could break its big pattern to the upside. It's possible that gold goes up more than copper as they both go up. It's a 40-year, absolutely massive, great-looking inverse head and shoulder. It's a double bottom breakout and backtest reversal pattern here, followed by higher highs. The inflationary 2020s could be very similar setup to the inflationary 1970s. That's the dark shaded regions. If this transpires the way that maybe this occurs in, we would also see, I think, platinum and silver and oil do incredibly well. And that's where I'm focusing my efforts, is to figure out what are the best investments in those sectors and getting exposure to it. Now, it doesn't mean that I put all my money in one individual company and guess which one it is. I want exposure spread across the highest probability of gains during this market condition, and then spreading across the companies that possess the characteristics and traits to create a portfolio to play this bull market in the 2020s for an inflationary regime. Come down. Okay, so this guy says the difference between making 400K versus 100K is massive. The difference between having 4 million in your brokerage versus 400,000 changes the trajectory of your life. What are these people even talking about? Someone says, honestly, it's pretty crazy how fast the utility of money falls off. The difference between my lifestyle of making 50K versus 100K is absolutely insane. But double it again to 200K or even again to 400K, and I get like a nicer vacation and an extra 2 rooms in my house. LOL. I would agree with both of these people. I'm going to state it a different way. This is how I'll state it. There's a point where you start making enough money and your lifestyle doesn't change very much. The bottom one, when they're saying between my lifestyle of making 50K and 100K is absolutely insane. So your lifestyle goes up dramatically to a certain point, somewhere between 50K and 100K. That's probably where it tapers off. Think of it where you make more money, but your lifestyle doesn't change very much. Now, the guy on top says the difference between making 400K versus 100K is massive. I would disagree. It's not massive. I would say it's very little. Your biggest gains, if I were to break it up, that I noticed when I was living, and as I'm living and I started making more money, I'll tell you what I thought was the biggest difference. Um, it's when if you've got a fixed, you basically have like around a fixed amount of cost or expenses. So let's just say that my fixed amount of expenses is $60,000. If you're making 50, you have to cut in places. So you're cutting things out, you have to conserve, and you're basically using every dollar there is. Now, if you have 60,000 expenses and you make 100,000, it becomes a lot easier because you have a cushion. There's a cushion there where you can absorb costs. You can increase your lifestyle a little bit without having to cut everywhere. That's where the big difference in lifestyle is from 50K versus 100K. Now, what's life changing is if you can start to save money and invest. And let's just say your costs are around 60,000 and you start making 100,000 take home pay. Forget the taxes, let's just make this math easy. So you're saving, if you're making more money and you're 60,000 expenses and you're at 70,000, you can save, let's say, 10,000 a year. Every little bit of money that you make above 50,000 can be deposited into investment accounts if you are keeping your expenses stable and not have lifestyle creep. So the more money you make, it's directly hitting your investments. So if you go from 60,000, which is 10,000 savings, to 70,000, you just doubled your savings. You went from 10,000 savings to 20,000 in savings. And it becomes larger and larger as your money goes up. If you go to 100,000 and you keep your expenses at say 60, you are now saving 40,000. You went from saving no money and basically scavenging around trying to figure out how to cut costs to saving $40,000 a year. That is huge between the difference of 50K and 100K. Now, 400K versus 100K, if you keep your expenses relatively stable and your lifestyle the same, you're just stacking more cash on top of it. The difference isn't as big going from 100K to 400K because it's a percent increase. It's the same difference as a high cost producer. It's the percentage of your savings goes up, but you're just stacking more away. So you're going to get to your goals maybe more quickly, but your lifestyle isn't necessarily going to change very much. There's a big gap in lifestyle going from say like 100 grand or 200,000 to like the next lifestyle bump. Driving a Mercedes versus a Honda, that's not a lifestyle increase in my opinion. Having a little bit nicer bed from an already good bed, not really a lifestyle increase. They're pretty similar. Everything starts to tail off in terms of value when you get to a certain point. So you can already buy a good bed, you could buy a good pillow, you can buy okay clothes because clothes aren't really going to get you there from a lifestyle perspective. You can take trips, but that could be considered lifestyle, better or not. You could buy a different house. Having a bigger house doesn't really impact your life that dramatically for most people. If you're in a 2,000 square foot house versus a 4,000 square foot house, and let's say it's just a four-person family, it's really not going to change your lifestyle that much. You have to really go all the way up to maybe tens or hundreds of millions of dollars, where you're starting to buy private jets or helicopters or yachts, and you're traveling and doing things on a completely different level, going from maybe public to private. Having a little bit nicer vacation, not a big difference. Going on a yacht or a private jet and doing things that are completely secluded, that is different. I'm not saying that it's that much better or it's life changing different, but it's harder as you go up. You'll reach certain spots in your life where, I mean, you really got to make a lot more money for it to be lifestyle different. And 400,000 versus 100,000, some people think that's a massive difference. In my opinion, it is not. Things in life are easier, yes. You have more cushion, yes. But I still don't think that the gap is that big. Could you buy a million or $2 million house? Sure. But a person who makes 100 or 200,000, they still live in a $600,000 house or $1 million house. The difference between a 600 to $1 million house and a $2 million house, it's really not that big of a difference. One, you might have some neighbors. The other one, yeah, you might be a little bit more secluded, but I still wouldn't say it's earth shattering. You're still driving automobiles. You're still driving mass transportation. If you're flying jets, you don't have private jets. You don't have helicopters at two or at $400,000 a year. Um, it's really not life altering and changing. The only thing it will do is more than likely it will get to your goals quicker if you're trying to have like investment goals. The difference between a 4 million in the brokerage account versus 400,000 changes the trajectory of life. Um, yes and no. One gives you more cushion with 4 million versus the 400,000, but I don't think it's going to change your life that much. That's my opinion. And I've had, this amount, and I'm closer to this amount. I've gone through this, and I don't think it's as big of a deal is what most people think. 400,000 is still a lot of money. It still gives you cushion. It still means that you're financially stable. And I think that's probably the biggest jump is going from financially unstable to financially stable. After that, once you hit financially stable and you start increasing above that, I don't think that it's that life altering, shattering difference. Um, you're still going to be probably in a single family home if you want to. If you decide to do that, you can buy it under both of those 400K and 100K. Um, but I would say the biggest difference is whatever your expenses are, as you get away from those expenses, as you earn more income above those expenses, and you start to stack more and more investments, that's the big deal. So I can't tell you what it is for each person. It's obviously highly individual. But if let's just say 60,000 is someone's expenses, as you earn more and more money above 60,000, the biggest difference comes when you cross that threshold of 60 grand and start saving. And then the percent increase on top of that is the difference. So if you make 70, now you're saving 10. If it's 80, now you're saving 20,000. That's a 100% increase from 70,000. And then you get to 100, and then you start going up and up and up and up. You're piling more money on, but the percent increase difference is less and less and less. So that's my opinion there. Um, I think that if you can save a good, let's say 20% of your income to 30% of your income, I think that's a pretty good mark to hit. So if you've got 60,000 of expenses, uh, you want to get up, let's say to 90,000, 100,000 or something. I think that's a pretty good thing to have there, somewhere around that area. Going to 400,000, it's great. But taxes come into play too. You're going to pay a lot in taxes. It depends what you have to sacrifice to get it. And I don't think it's not as big of a jump. It's not as big of a difference getting up there. And that's it. That's what I've got for today, guys. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. It's the coupon code in the corner there. And that's all I've got for today. So we'll catch you next time. This is Finding Value.